Welcome to the Game of Finance. My name's Matt Spears, and today we have a very special guest. We've got Brodie, the CEO of Wealth, a non-bank lender. Brodie, welcome.
Thanks for having me today, mate.
Pleasure, mate. Appreciate you taking the time to come down from sunny Brisbane. Mate, I'm really looking forward to today's chat because I think for a lot of the clients that we work with, being investors and business owners, the non-bank option is something that they're not overly enthused when we look to bring it up as a potential option for them to explore as part of their lending. And I think it's probably not misunderstood, but there's not enough knowledge around what non-banks are and their place in the market and how they're not too different from the major banks that most people are accustomed with. And I guess for us, Wealth is a company we do a lot of work with. We think it's a fantastic option for our clients across many different product lines. So for me, today's chat, I'm really interested to learn about yourself and learn about the business and how your journey led to you building Wealth and being the success that it is today, but also unpacking a lot of the options around how we can use non-banks effectively and how we can look to offer them to clients so they can fully understand how they can benefit their journey. So, mate, would love to understand a bit about yourself and how, Wealth came to be.
Thank you very much. That was probably the longest, most succinct introduction that I've ever had, so I appreciate that. First and foremost, thanks for having me today. Matt, it's good to sit down with you outside of a PD day or at an awards ceremony, which you seem to be at more often than not these days. So
thank you, mate.
Testament to the work that you're doing with your business and your clients. Look, in terms of non-banks, lots to unpack. Let's start with the old Dolomites.
Yes.
CBA, at school, grade 1. I'm not sure. How old are you now?
37.
37
yeah.
On the record. Okay, I'm 39. So I'm 86, you're 88.
That's right. That's right.
Yeah, perfect. So you probably would have still got the Dolomites
Absolutely.
The
I
old
had
pouch.
my gold coin to put in the pouch at school, and CBA would come and pick it up from class and, offer me a credit card when I turned 18. That's
best marketing gimmick ever, right? So the longest customer life cycle of any brand out there, probably, CBA's Dolomite campaign, rivals the Golden Arches in my view. But what we've seen over the last, in particular, 5 to 10 years is that systemic shift in, the Gen Xers, the baby boomers, relying so heavily on the major banks in the Australian market. And it's really around choice, option, flexibility, and people, I believe, the wider market's becoming smarter and understanding the correct financial structures that exist out there today when, looking at a loan with CBA versus another bank versus a non-bank, and understanding more than just the headline rate or the hook rate or the advertised rate, and starting to understand things like the comparison rate. What features, what structure, what LVR, does it include offsets? How will it help me? What does it, overlay with my strategy and, my circle of influence from my accountant or property advisor or financial planner or, whoever's in your world and your center of influence. So the big misconception I feel that we experienced, particularly when we started and launched in 2020, was trying to build that trust. How do you write your first loan? How do you get your first consumer to buy into your brand and what you're doing? And really what it comes down to is the huge difference between non-banks and banks is that we can't take deposits. So yes, we can still have offset accounts. Yes, they're still protected. Yes, they still function the exact same way, but we won't be able to have a savings account. So your standard deposit taking institution. So that's not what we are.
Understood. And that's, I guess, a non-ADI, authorised deposit taking institution that some people at home may have heard of. But starting in 2020, not the easiest time to start a business or operate as a broker or operate a business for that matter. The journey to starting Wealth, how did that come to be? You're a young guy, young family. How did your journey to create Wealth start, and how did you manage that with such a young family at that stage?
It was more of a non-institutional style entry into the market to get where we are today with Wealth. So myself, my co-founder, who's also my brother, Drew, we've been in business together for 15 plus years now. So we started in property advisory and then got into finance brokerage. And then for us, it was about solving pain points. We never wanted to start a finance brokerage. The reason we did is because the brokers we were outsourcing to at the time couldn't give the service level that we required for our customer base for the property advisory. So we're like, okay, we'll go start our own one. And we started to learn the ins and outs of the sector, and that led us into technology. because we wanted to provide our own CRM for our customers to help manage their wealth, to help manage their portfolios. So we built a tool, Money Management, which we've since exited, which basically was an aggregation tool of data. So it had bank feeds, super feeds, valuations of property, etc., all in one simple app, which worked quite well. And then from there, we then looked at identifying an area in property investment where there was these old archaic tools that looked like they were built on Minesweeper. So the old, Jan Summers PIA, which is still in market today. It doesn't work on a Mac, but you've got to download some other software to make it work. And we looked at that and said, surely someone's going to turn this into an app. We were proven wrong. You still get served content on Instagram these days about these super spreadsheets or, the answer to property investing, and it's another Excel spreadsheet template. Yes. So we effectively took the PIA and our other learnings and knowledge and built Properlytics, which still operates today, live on the App Store, Google Play Store, and it's just property calculations and cash flow tool for property investors to help them work out what their after-tax cash flow is and how their portfolio is tracking. So for everything that we've done in business, it's always been about trying to solve a customer need. And when it came to lending at that point in time, probably around about 26 to 2018, we became really frustrated with banks and also some non-banks about turning taps on and turning taps off in terms of product, funding, etc. The main one for us that kind of was the straw that broke the camel's back was around, must have been 2016. And we had just started delivering a lot of our clients into SMSF for property, which, in reality was probably before it became quite a hot topic and so commercialized or, as popular as it is today. And we had 55 applications in with AMP and they turned the tap off. I'm talking unconditional, formal applications, ready to settlement, and the tap's turned off. So you have to start looking at other options. And then we started exploring different non-bank options and then worked out how they got their funding and started, uncovering and unlayering the dark arts of the money system and sector. At that time, we actually met our other co-founder, Darren Hodgkin, who's an English expat based out of the UAE. And he was talking about, what was taking off with the fintech wave and digital banks and neobanks over in the UK and Europe in particular. We were saying, look, we want to create a new digital lender in the Australian market. So we joined forces with the idea of potentially building some form of digital bank. And that ideation was around 2018. It got to COVID and in 2020. And then we said, you know what? Everyone's at home. All of our team are at home. Let's just do this thing.
Amazing. And that's a really interesting time too, because I wrote a lot of self-managed super, and we still do as a brokerage, but throughout my time at Westpac, which was 2007 until 2019, major banks were writing self-managed super fund all the time. They loved it. It was great debt for them because it was long-term sticky debt, P&I, on their balance sheet, which, would amortize and provide, diversification for those clients looking to move out of equities. And I guess with the roaring property cycle that we had from probably 2015 through to 2018, with the Royal Commission that sort of kicked in as well, we saw a lot of that regulation change, which made those major banks make a decision to exit self-managed super fund lending. That left a lot of those people looking for that option with absolutely nothing. There wasn't a solution out there that was commercial for them to be able to take and actually purchase that property with. So it sounds like in terms of, I guess, your decision to move forward with a digital bank, idea, was that influencing your decision as well?
Absolutely. Like if I was sitting in an interview going for a job these days and they asked me, Brodie, what is your strengths? What's your weaknesses? How I would coin myself is I'm just a professional problem solver. That might sound arrogant or cliche, but it's really about we get objections or we find issues or walls that pop up and then we just go into solution mode. How do we solve for this? What can we do to create something that hasn't necessarily either been created before or to unblock pain points within the industry or the sector? So, going back to 2020, at that time, we originally had the idea of becoming a neobank or a digital bank. With that, we thought we need to probably collect a little bit more knowledge. So I went off and studied the fintech program at Oxford University, and as part of my thesis used the restricted ADI license to understand what the loopholes were, how does it work, is it commercially viable? And it might sound, again, a bit tongue-in-cheek today to say it, but we were saying it back then. It wasn't commercially viable. The capital requirements of a restricted ADI moving into an ADI was, in our view, fundamentally flawed.
Gotcha.
And we saw that with the likes of Volt. We saw that with the likes of Zinja. We've seen it with the likes of some other restricted ADI, neo or digital banks in the Australian market have now flipped their business models to become more software providers rather than actual banks themselves. And there's a lot of other new incumbents over the last 10 years that are really struggling now. And where we saw the opportunity was, well, why don't we take the regulation, understanding where funding can come from in terms of you don't have to just lend off your balance sheet. You don't have to be, create deposits with Dolomite accounts and then lend them out on the other side of a ledger. There is different flexibility and option. So we thought, okay, how about we try and walk, talk, quack, and act like a bank without the need for a banking license? Yeah. So that's when we really drove hard. And then, within 14 months, and, I truly believe without COVID, we wouldn't have been able to stand this business up. We wrote our first loan.
Wow. And what are you doing at the moment in terms of your run rate for, say, FY25, FY26? What are you looking at in terms of volumes, if that's something you can discuss?
Oh, no, I'm just kidding. Of course we can. So right now we're managing a loan book in excess of 1.65 billion. From a running start. We have acquired a traditional style mortgage manager in the market, which was Mortgage Mart of Australia, which we're still operating today. And for us, that was an inorganic or acquisition strategy that we wanted to utilise in order to expand our distribution and database and lending over the next, we've just done our calendar year 26 modelling. We're looking at between 650 and 850 million.
Amazing.
In terms of settlements for the calendar year. And where we've gone to from the start is, look, let's stand up a digital non-bank lender. We want to fill out the rest of our product suite with all alternative forms of credit. So specialist credit, our whole tagline from the start has been solution-based lending. So again, just going to problem-solving mode. What different products or sectors can we solve for, whether it be SMSF, whether it, previously turned it off now, but NDIS or pulled back on it. High LVR construction, what do investors want? What are our experiences in terms of how can we provide different forms of funding? So we've just launched a future trail funding product to help support brokers to be able to realise their loan book as an asset, as an example. That will move into next year into more development finance, commercial finance. And where we want to sit in terms of the lending market is to be the most broker supportive lender in the market. So
amazing.
You can come to us and we can try and find a solution. And that's through the manufacturing of policy and product.
Fantastic. And that's really interesting because as a broker, we're here to solve a problem as well. I think any service provider, like your one role is to be able to provide that service and deliver for a client to solve that need. And what's interesting, just to play back the key difference, it's the ADI versus the non-ADI, with major banks versus non-banks. And there's different sets of regulation, which are obviously going to govern the price and the amount of capital that you need to hold as well. But to sort of dive into the funding sources. So if we look at a major bank who is providing loans to the market, they're self-funded for probably the majority of the loans that they look to fund. So those Dolomites or those working capital accounts are funding the loan book that they're looking to lend on the other side. But when it comes to the funding lines for a non-bank lender, because they're not taking deposits themselves, where are they getting that money from? Like, where are those funding lines coming from?
So there's a mix. There's your standard private credit providers who are non-banks, where they'll get investors to come in and invest in different residential mortgage-backed securities or different private credit funds or listed funds. And then there's also this world of warehouse funding. Take Wealth as an example. We work with two of the largest warehouse funders in the country, and majority of their funds actually come from the major banks. In reality. So it's quite funny, but it's easier for a major bank to deploy capital into a warehouse in terms of, we need to get 4 bill out the door in the next 6 to 8 weeks than it is for them to try and acquire a customer. And we talk about customer acquisition and people might think it's a bit fugazi or convoluted or really hard to quantify your unit economics in a business. But we saw at the back end of the interest rate cycle, all the cashbacks coming from the major banks. Now, they're no dummies. They would have looked at what's our customer acquisition cost for a settled loan. Let's just give that back in cash back to either retain customers or to attract customers. So in our view, we think it's a lot easier for the banks, and this is proven by the growth of these warehouses over the last 5 to 10 years, for them to deploy into these warehouse funding models where then the warehouse will then split it up and provide it to different lenders or mortgage managers or people that want to have their own products in market.
And we've seen that grow across the network, right? So across the landscape. So if we look at, I guess, the last 5 years, we've had broker market share double, up to 78%. We've had the amount of non-bank players in the market grow considerably, and they're really benefiting the investor, because we're getting so much choice. And I think that's probably a great spot to talk about is why is non-banks so powerful for investors? And I guess talking from the clients that we look to manage, because non-banks have a different set of regulation attached to them, there's different, I guess, policies or regulatory frameworks that they need to comply with in and around serviceability or say policy. And for us, I think that the policy niches that we find that really help our investor customers to move them forward is when we're looking at serviceability. If we were to walk into a major bank and look to purchase another property, if we had, say, $1 million worth of exposure at another bank at the moment, we would need to buffer that current loan at a 3% buffer rate. So existing rate may be 6%. We need to test that debt at a 9% interest rate for the new lend that we're doing with that new bank. Where for the non-bank options, depending on the bank that you look to use, you can actually take that new debt and buffer that new debt with that new non-bank. But the external debt will actually have a different level of buffering or potentially no buffering on it where we're using the existing repayments. Why is there that different level of regulation or policy, application at the non-banks than there is at the major banks?
Yeah, so in terms of balancing banks' loan books in totality, it's delivered from APRA. So they'll have different concentrations of the type of lending that they can have, and majority of that is taken up in owner-occupied lending. So the mums and dads of the world.
Which is often the most cheapest, debt for them to price because it's low risk. We've got the home. They want clients to pay it down because everybody needs a place to live. Hence, P&I, home loan pricing is the cheapest pricing you'll get.
Yep. With that comes the limited opportunity for them to be more creative on the fringes. So unlike a major bank, us playing in this non-bank digital lending space, we're not governed by those same regulations. So, right now we have exposure of 55 to 60% of our total loan book is in SMSF lending. Why is that? Well, one, we're not governed by it, but two, we also understand the importance of the structures. And you talk about flexibility around things like servicing. So the banks will have their policy box, and it's very hard for them to go outside of that policy box, right? For us, in order to be competitive, but also understanding your customer more, which is where I really think that the non-banks have a real positive place to play in the market, is they are understanding the customer and they're understanding that they don't need to add a buffer of 3% to the rate, to the floor rate.
Because that came in when we were at sort of the lowest rates in 60 years, or would have been 4 or 5 years ago now. Yep. So that increase on the buffer used to be 1%, went to 2, and then it went to 3. And when we're at the top of the interest rate cycle and we are seeing rates come down, there is a lot of chat that, that is, I guess, onerous. It's not at the level it should be, but we've got probably APRA worried that, well, we've got rates declining. We've already got a housing crisis. If we're to remove this, it's potentially going to fuel that more. So would that be fair to say in terms of the bank's view and APRA's view?
That's definitely the view of APRA. I don't agree with it. You should be able to ride the cycle. If you're going to increase the buffer on the way up of an interest rate cycle, why wouldn't you decrease it on the way down?
Agree.
But why is anything ever rational in
correct
in business and in the markets? We can go open a whole Pandora's box if we want to talk about where the RBA is heading and what the view for the next 2 years looks like. But you hit the nail on the head. It's around serviceability. So one thing that I think has worked really well over the last few years in the market is these other providers out there that are solving needs. And you talk about quickly, and you talk about a platform which has organically grown to, I think they're probably close to 12,000 plus broker subscribers now. Great guys, if you haven't met them.
Yeah, they are.
Really
lovely
awesome
fellas,
dudes.
yeah.
But I think that particular tool plays such an important part in the industry, particularly for brokers, to understand the different nuances, niches, how servicing calculators are built, what, different things are being serviced on, what the add backs are. Because if you're trying to retain that knowledge as a broker, it's near on impossible. You might interface with 70 different lenders, then you're trying to cover best interest duty, you're trying to match that to a particular client. You can't retain all of that knowledge. So I think that's a really cool tool, and it's definitely helped drive a focus towards non-banks and understanding how they service differently compared to the majors.
Correct. Yeah, Quickly's been a great tool for the broking network to get more visibility on all of the options out there. And they're the type of conversations we have with clients who probably have traditionally always worked with major banks, and that's where their comfort lies. And there's the brand recognition, and that runs deep for somebody who maybe 25, 30, looking to buy their first home. They've had that coaching of the major bank model for a very long time. So for the conversations that we have with our investor clients, it's very much about, well, we want to work with best rates and terms, but we also want to understand what your longer term strategy is. Mm-hmm. If you want to buy a home, but you also want to invest, if we look to buy a home at this level, we're not going to leave ourselves a runway to be able to do the investing. And what's more important, a house or building wealth to, potentially not be able to work as hard or as long into the future. So that's where for us, when we're really looking to unpack what are all of your options, it's about looking at, well, if you're an existing investor, what does your existing property portfolio look like? What does it look like from a valuation perspective? What does it look like from a lending perspective? And then once we understand what that foundational level worth of equity or serviceability is with the major banks around the existing properties, that's when we want to look at, well, if we're able to take that equity out and use that as our foundation for our investing moving forward, what does it look like in the second phase when we're looking at investing? And what does it look like in your personal name? What does it look like in a company or a trust? And what does it look like via SMSF as well, both via bank and non-bank options? And I guess the reason we do that is we're getting a really clear view on your current position and how we can make sure that structurally that's aligned. But then we're giving ourselves a funding roadmap where we can say, look, we can work with the major banks, but this is where you're going to cap out, or this is the level of capital that we can deploy to purchase an asset. And is that going to be enough to buy something that's going to be the best quality asset and give us that growth that we want over time? And that's where for us, we're seeing non-banks as such a key part to that equation, because for us to be able to follow best interest duty, which we're governed by, to give clients all of the options, sort of running through why serviceability is such a great option, why with SMSF transactions having offset can be so powerful. And it's very rare. I don't think there's sort of many other players out there who are offering offset within super. And I would probably assume that they don't want to offer offset within super because that's going to, erode their potential returns if people have money left over, once they've made an investment. But why did you guys make a decision to include offset as part of your product suite for your SMSF product?
Yeah, it's a really good point. So for limited recourse borrowing arrangements, as you would be aware, and maybe some of your listeners aren't aware, you can't refinance your equity or redraw on your loan inside of super for it to be compliant with the SIS Act and the regulations. And I feel, based on our experiences, like we've spoken to chief risk officers at major banks, I won't name them, but they think that superannuation or SMSF lending is a risky or flawed strategy, and they were doing it at, say, 60% LVR, which is a whole other story. But it's so fundamentally important to have a offset account attached to an SMSF loan, because that is your way to be able to build up your cash reserves to be able to reinvest. There is no point just paying down a loan inside of super. And for us, it's all about the importance of what works for the customer. Like, what is in the best interest of the customer?
Yeah, it's giving them choice, right? You know, and I think that's where having that offset within your SMSF gives you the ability how you choose to deploy that capital. So if you're getting a 25, 30-year P&I loan, there's a minimum level of repayment that's required, to meet your obligation with your bank. But if you're putting in more cash than what's required to meet that obligation, you want to be able to use that at your discretion. You don't want to have to commit that to debt reduction. You want to enjoy the benefit along the way. So if you're saving, 6.5% interest, and that's net, you're saving that net because it's pre-tax. The gross money that you would have to earn is going to be higher than that. So you can make a decision of, well, I'm saving 6.5% net on this money sitting in offset. Can I deploy that money and earn more than, 8, 9, 10% gross or whatever that effective rate may be in another asset? So you're having that choice. And again, you need to get your advice from your accountant, your financial planner, just to make sure that everybody's making sure they're assessing their personal situation. But that's an element of choice that clients get. And if you don't have that as part of your product, you don't have the ability to make those decisions.
Absolutely. I think it's unfair to the customer or client if they have got a SMSF loan, which they've just put on P&I and they've had it for 10 years and they're paying down that asset. It's a fundamentally flawed strategy. It limits their ability to be able to either repurchase or reinvest. And it's so important around the preparation. So, why I love, speaking to brokers like yourself that take the full financial picture of a client or a customer into consideration, as you are so well prepared before you present options to your customer. So they may have never even thought about an offset. If they've set up their SMSF with their accountant and it's self-directed and they're doing it because they've heard some things, and then they, go direct to a lender and get a loan in place and it doesn't have an offset, they've pretty much killed their strategy and their ability to be able to repurchase. And for self-managed super funds in the Australian market, we're very, very lucky compared to anywhere else in the Western world that we can leverage our retirement savings. Like, that is a phenomenal option. That's why it's so big these days. We talk about it and the media is so heavily skewed towards the Australian dream is to own property and invest in property. Yeah, great, tick. But the reason why it's so important in super is because of the leverage point. Archimedes said, give me a lever long enough and I can lift the earth. And it's so true in
I love that. I'm going to steal that. That's great.
Oh, it is. It's true. It's probably not exactly, word for word, but philosophical.
Yeah.
And why wouldn't you? Like, you talk about serviceability, and the thing that we see and that we focused on really heavily was solving the self-employed market. Because as a business owner, you may have multiple companies, trusts, businesses. You might be running some at a loss and some at a profit, or, it can be a minefield. And if you went directly to a major bank, it's not going to fit the box.
Yeah, they only look at full doc. That's right. They've fully removed the low doc options from major banks. So, those business owners that perhaps are playing the tax game, upon accountant's advice, or, I guess don't have the numbers ready to actually provide that information, previously didn't have a lot of options. We're now, with the non-bank option, we're getting, those options for clients to get into the market, to take action and be able to actually benefit from having, additional skin in the game to leverage and enjoy the benefits of compound growth.
Yeah. And the difference can be, and you would see it on the direct investment side or the self-managed super fund side, sometimes the difference in the quality of the investment is significant, and it could be $100,000 worth of lending is the difference between buying a unit or a townhouse versus buying house and land or a dual lock or co-living or commercial property or whatever it may be. And that's so important because you look at the capital growth perspective of the particular investment, and it could be, life-changing in reality.
Oh, it's huge. I talk to clients all the time when we're talking about price points. And, for me, it's always about understanding, if you're using a buyer's agent, which I'm a big advocate for, and I think everybody should if you can afford it, you want to understand what you can borrow first. You want to understand all of your lending options, so that lending runway that we build for our clients. And then you want to talk to an expert to understand how to deploy it. How much do I need to spend in which area to get the maximum value? And it could be, if you're only able to borrow $600,000 with a major bank, but you can borrow $800,000 or $900,000 and you've run your numbers and you know that from a cash flow perspective you can afford it, that may get you a much better quality of asset that's going to get much better capital growth and potentially a better yield versus the asset that you could have bought if you just went to the bank that you've always banked with. So for me, there's power in options, and for us, non-banks provide that in spades. Speaking of non-banks, what makes a great non-bank in your view? I guess for me, flexibility from a policy standpoint for our investors and our business owners is really important, and having that depth of products that really suits. But in your view, what do you think makes a great non-bank for brokers and also for clients?
So for us, it's really around our North Stars. North Stars being we want to have the best service level that we possibly can to our ambassadors, which we consider our brokers as our best ambassadors. They're our sales team, effectively all over Australia, telling people about wealth. And then obviously for our customers and clients as well. And what makes great service is speed, knowledge, understanding. So that can be broken down between how quickly can we get a loan approved. So we've been working really, really hard and invested, tens of millions into building our loan management system and integrating with our origination system and working through rules-based engines to provide instant approvals across our product and policy suite. And we believe that by mid-next year, all of our products in our residential and part of our commercial lending space will have instant conditional approvals as long as the LVR is below 80% and we can rely on an AVM. We should be able to go tick, 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 green light, green light, green light. There you go.
Amazing.
And
commercial, you said commercial.
Yeah, part of the commercial. So more so on the refinancing of commercial of properties, because for new purchases, if we get into development finance or in that commercial space, if it's being constructed, it might require a bit more than hitting a rules-based engine or a matrix of policy and code.
Oh, of course, yeah, a lot more complexity, but that's a new, I guess, element to wealth, isn't it, in terms of the commercial lending piece?
Yeah, I mean, we just look at what the market wants from us. So in the last 18 months, as a bit of a high-level rundown, we've had the launch of our modular homes construction product, where we can provide construction drawdowns while a modular home's being built in factory, which is phenomenal for the customer, but also the modular builder, because they're then getting paid throughout the course of that build, and they're not waiting for the customer for the modular home to be delivered on site, and then they've got to pay for it 100% up front before it lands on the land. That's a big component of where we think the industry will be heading over the next 5 to 10 years in terms of modular builds. It saves time. It's actually a lot safer. There's less risk. They have higher quality building methods if you talk about the future of construction. Then we've looked at other products. We've partnered with a shared equity provider to help solve the housing affordability crisis for young professionals who just don't have the bank of mum and dad, don't have the ability to be able to save the deposit, and the market's running away faster than they can save. And that business is called Mondus, and we're working really closely with them. And then it's our other specialist products. So we have been working for about 2 years on a portfolio product for investors, whereby we'll be able to balance the scales of interest. So we provide a blended rate across your owner-occupied and your 1, 2, 3, 4 investment properties. And we drop the owner-occupied rate and we put it towards the tax-deductible investment rate.
Amazing. So, and for those at home, again, when we're putting together a strategy, the main thing we want to do if we're carrying owner-occ debt is we want to really point the cash flow gun towards paying that back. So if we had the ability to, I guess, move those rates around, so we've got an overall blended rate of X, but we can ratchet the home loan rate down to 2%, and it means we take the investment loan up to X. That's going to be a massive benefit, because the cash flow can point towards that home loan, which is non-deductible debt, and we're happy to pay that additional debt on the investment properties because we're going to be getting that tax deduction.
Absolutely. And it's all about reducing the non-effective debt. So that's a product that's very dear to my heart. Like, I really want to push that out. It's more so the technical componentry at the back that we're working on at the moment, but it's really exciting. And then moving forward, we spoke about future trail funding and the ability to support brokers with realising an asset from their own loan book. That then leads into, we've had so much inquiry around development finance and commercial finance, and we're working closely with one of our major warehouse providers to be able to fill that market. To fill where the Latrobes play really well, that sub $10 million space, or working with self-employed people, or helping them buy their own industrial shed, or doctors to buy their own surgery, or whatever it might be. Again, it comes back to, what are we trying to do? We're just trying to solve needs. If there's a requirement and we're hearing different things from different people, then we'll look to bring that product to light. We'll manufacture that. And
it's something that's getting a lot of attention from our investor clients who are building that really strong residential foundational portfolio. But they're earning that equity, but they want to start putting that into higher I guess, return assets like commercial properties. So for us, it makes complete sense. You know, a lot of the clients that are buying resi, they want to get to a point of commercial in the future, but those that actually can acquire the commercial along the way could actually pick that up for a much better price now, instead of waiting the full journey, selling down and then buying back in. They can actually buy that jewel in the crown or buy multiple jewels within the crown, and then liquidate that resi position and then open up that cash flow, you know, when the resi returns give them the ability to do so. So definitely something we'll be using in the future. So outside of the new products, what else is on the horizon for wealth?
So what does the future look like? For wealth, it's about delivering the rest of our product roadmap. So we've got a payments platform that we'll be pushing out to market in CY 2026. And then it's about creating this ecosystem-based approach to finance. So how can we support our business customers with business credit, you know, extending upon what we've done in the broker funding space? How can we add further products that solve different niches within the industry? But for us, it's all built on our technology. So our technology is now underpinned completely by AI. And a lot of people have been speaking about AI, or how do you even have a strategy for AI? And it's something that we doubled down on about 12 months ago. And I'll give you a real basic explanation of how it's completely transformed our business. And we focused on the back office functionality first. So if you go into the broker portal today, which you have access to, you go straight into our chat. It's an AI chatbot, which is a knowledge base, which pulls directly from our policy, product, rate cards, etc. So it's quite funny how much the accuracy of the communication between our team and our customers and our brokers has changed over the last couple of months since deploying that. Transparently, I'll sit in a meeting with a broker that I might have 3 or 4 a week, which, you know, BDMs invite me along to have a chat. And I'll just have my computer there with the chatbot open, and they'll say, oh, what's your rate on 70% LVR, SMSF commercial in this postcode? And you just go bang, and then it gives you a beautiful answer. And then you can say, here you go. And you can sound really smart, but I can't actually retain half the information around credit policy and product. I can't even remember what I had for breakfast, to be honest. But
that's the thing, right? I think a lot of people are scared of AI, but I think, you know, those that adopt it, it's going to enable your sales ability. It's going to really enable better quality conversations with clients, to be able to move the needle from a speed to market perspective, but, and also an information gathering perspective. So it sounds like you're a subscriber that, you know, it's not going to take away roles. It's probably going to, I guess, consolidate some back end. But for me, it's really going to add value to the front line and those client conversations.
Value to the front line. And then more so, where do we see the vision, you know, the macro vision of where wealth will be in a few years is we'll have open banking. You know, CDR is already being rolled out at the moment. So we'll have to report all of our data to our customers, which will make it a lot easier for people to be able to switch in the future. And I think that that's really exciting. You know, a lot of lenders, non-bank lenders, a lot of banks out there even are quite scared of it. They're scared of the switchability that open banking will provide. But I think
they think they're going to lose control of the client. They're going to lose the window, which is, you know, internet banking, the portal to the client's information. But
power to the customer.
Absolutely. It's coming anyway. Like if you look to fight it, you're probably going to lose market share other ways. You know, you look what's happened in the UK, you know, they've been the early adopters of forging that path. And, you know, it creates products that create better solutions for clients. And I think those that don't, I guess, come to the party, you know, are going to be left behind, and clients are going to vote with their feet.
And you hit the nail on the head. It's all about the customer. So I think it's so exciting for a customer to be able to, you know, log into the wealth portal. They'll be able to see all their lending. They'll be able to see, you know, their live LVR. They might be able to be fed dynamic content and be like, did you know that you could actually qualify to purchase a property of $900,000 based on your current income or super contributions and the value of your property, and pull this data back in. And this is where, for me, it's almost like a full circular moment. You know, we had a PFM tool, personal finance management tool. We've been in finance, property, wealth creation for a long time now. And where technology has brought us is almost closing out the vision that we had back in the day that we didn't realize that we had. And yeah, I'm like so excited about where it will take us, and you have to get on board with it. Like, you have to get on board with the technology. You have to see how it can help solve problems in your business. But if you can always have the customer at the center point of your focus, I think you'll always win.
I agree. It's kind of like Steve Jobs, you want to start with the client experience and then work backwards. You don't want to build a product and try and align it to the client because, it's not always going to match.
Brings me to another good point as well, and we haven't spoken about it yet, but the biggest USP, and then you asked me at the start of the discussion around how do we attract customers as a non-bank lender, and we really had the opportunity to build this business model from the ground up with a blank piece of paper. We took the time to prepare how we're going to roll out wealth, what are we going to stand for. We've always wanted to involve some form of purpose element, to be an impact organisation, and we are now actually Australia's first impact lender in the market.
Wow.
And it's a new seal that's been created between Wealth, some guys out of the US called Movement Mortgages, who are based out of Charlotte, who do a lot of the impact space, have, it pains in comparison to Wealth, but have invested, over $500 million back in education in communities over there. And they were looking at some form of other lender around the world that was providing some form of purpose-led element. So we were really lucky early days in the ideation phase of Wealth, and we said, look, we're in Australia, in our national anthem, we're girt by sea, and we have an affinity with the oceans. So, myself, Drew, we grew up sailing, surfing, in the water. Every family holiday or positive, family holiday memory involves somewhere at a beach in reality. We have a crisis around marine plastic pollution. Like, I wouldn't call myself an eco-warrior, but I can see that that's a real issue. It's now in our blood, it's in the air we breathe. And we saw Parlay for the Oceans, who are based out of New York, and thought, wouldn't it be awesome if we could partner with them? At the time, they were partnering with Adidas and had run one of the most successful purpose-led campaigns globally, where all of the Adidas shoes, apparel, and paraphernalia had some element of recycled ocean plastic. They took waste and turned it into a luxury yarn. We were speaking with all these different card manufacturers about, our symbol for change is going to be our wealth card, and it's obviously mortgage offset linked. And how can we create a fully sustainable card? And we went so, almost autistic, for want of a better terminology, and being so hell-bent at wanting to just focus on how can we deliver this into market. And that was a journey to deal with Visa and to deal with card manufacturers and find out how much greenwashing actually existed in the space. And we jumped on a call with Giuseppe and Deveront, who are our card manufacturer, and we spoke about it, and we spoke about who they were dealing with. And they said, we're just about to sign up this deal, and we could probably get you on a video call with these guys tomorrow. They're based in New York. And we said, if it's Parlay, we'll be on. And
amazing.
4:00 the next morning, we're on a call with Giuseppe and Deveront and Parlay for the Oceans, and we talked to them about our spiel. And the founder, Cyril, was so thankful for our enthusiasm and our understanding of what his vision was and what they were trying to achieve, that he's like, yep, let's do it. So a little old fintech, based out of Brizzy, we're able to secure a partnership with Parlay for the Ocean. So for every loan that we settle now, we commit to cleaning up 50 square meters of Australian coastline and beaches. So we do different cleanup events, and we've done, gone up to the reef a few times and done coral spawning and worked with marine biologists and understanding the different impacts. And we're really proud of that. You can see it. I'm excited talking about it.
Absolutely.
And it's great for stakeholders. It's great for your staff. It's great for your team. It's great for brokers, people that you want to interface with and talk about that message. Great for PD days. We'll have the we'll have the actual plastic waste that we've cleaned up. We'll showcase it, talk about it, how that gets transferred to plastic pellets and then turned into the wealth card. And, while a cardless society is where we're heading, and obviously that makes more sense because it's less plastic. Recycled plastic is just as bad as non-recycled plastic.
Oh, of course, but you're making a difference where others aren't, right? And I feel like we're very fortunate to be in an industry that can make a lot of positive change in people's lives from a financial perspective. That with that scale, if there's those opportunities to give back in other parts of life, that would be incredibly rewarding.
It absolutely is, and that helped us instrumentally when we launched, because we had a USP as this first purpose-led lender in the market. People didn't really know how to take it. Are you guys the plastic waste, guys that you would speak to different brokers in the market? Are you guys the ocean dudes? Like, I don't even know what that means, but yeah, we're proud of it. Like
Yeah,
it was
we'll take it. We'll
point
take
of
it. Yeah,
difference.
we're doing some great business, but we're also, making an impact, out of the balance sheets as well. Which,
and where
is
that
always fun.
heads in the next 10 years, I think customers and the consumer market will be so much more cognizant of that. It's taken a little bit of a hit over the last few years because of affordability crisis. In reality, people have been less inclined to support NGOs or to support charities because they're feeling the pinch money wise. Like we totally get that. So if we can help people, provide that cleanup impetus and make them feel like they've been part of something bigger than themselves is always a great opportunity.
I think it's great. And for me, I get clients who ask us that, if we go with this lender, what are they doing outside of banking? And a lot of the time, we can't articulate what they're doing because it's not either publicly known or it's not something that they put out into the market. And I think it's important that you do because it raises awareness. And it's also providing clients, I guess, some context on who you guys are outside of an online digital bank providing a service. So I think it's great. Brilliant. Brodie, really appreciate your time today, mate. Thanks for coming in.
Thanks for having me, Matt. Great conversation.